Good evening. This is Ken Long from Tortoise Capital with a review of some case studies from February 18th and 19th, 2014. These are several regression line crossover patterns, and we're going to demonstrate how it's possible to link swing trading and intraday trading together through this common framework. So the story begins on February 18th, Monday, 2014. And we've just been experiencing for the last 8 or 9 days a bullish rebound off of early February lows, which continues into a daily doji with some trade opportunities we had along the way on Monday. And this is what I mean. You see here daily charts of the last 4 months, or daily bars, last 4 months. We have the river, that's the plus or minus 1 Bollinger Band, 30 period. The lighter blue shaded area is the river, that's Bollinger Band plus or minus 2. And we've got two RAF regression channels drawn in here. The blue one is 10 and the black one is 30. So the vertical blue lines show 10, 20, and 30 days worth of look back. And so what we had at the end of January, right around the 21st, we had this triple top put in place here at about 185 all-time high. And then about a 5% sell-off into the opening days of February, culminating in this large red candle down that took price outside of the third Bollinger Band, which is this dark red line here. Well, the market found support at about 174, so off $11 from 185. And found support for a couple days and then started taking back off. We have a Z-score trade that begins in here when price crosses back into the floodplain, and another one not later than entry into the river. And so then we get 10 days of pretty extraordinary rebounds from 174 all the way back up to almost 185. So as fast as it came down, it actually went up even faster. You can just see that steep regression line and that tight channel showing how powerful that move was. The 10-period Bollinger Band, plus or minus 0.5, which is the dragon, you can see, had come all the way out of the river into the floodplain and now reversed and closed higher. Well, on February 18th, the market closed in a doji right after this powerful move, just short of the all-time high, and puts it right at the edge of a channel, which is a place where we would not be surprised if it were to fail, because that's what it did the last time. And so this puts us right at the edge here of the yellow zone and the green zone. Green zone is where I want to be long if it takes out the previous high, and then it's all systems go, no resistance overhead. In the yellow zone, however, I want to be trading in the direction of the primary move of that day. So this is tactical trading in here. I want to stay with the primary trend. I hope it's still up. That makes it easy. But if we get a down day, then I want to move in that direction in the same way that, as you can see in these big red candles, intraday, those trends are very pronounced. And you can get those in a bull market like this. So while we're in this tactical trading zone here, between 0 and 5% of market pullback, I want to go with the direction of the day. If it had violated below 177 into the red zone, that's where I want to definitely be short on the weakest sectors of the weakest targets, much in the same way in this last down red day here in at the start of February, we had a downward bias. So that's the position we were in on Monday, February 18th. A typical trade in that day would occur, we're going to see in a minute here, a trade in XIV. So I want to show first SPY on a swing trade. The last framework was dailies. Now we're going to dial down to 2 hours and 10 days. And you can see the same lens, the same framework. We have a regression line crossover here outside of the river. That's pattern 1 in the RLCO. And you can see the price ribbon here, which is the 2-period Bollinger Band. Reverses and is closing nicely, and this is where it goes from that 174. You can see the support level here, then a regression line crossover outside the river. There's entries all the way through here, and then there's a nice orderly move over the next 10 days using these 2-hour bars from 174 all the way back up to 185 again. There's a regression line crossover here after the first move up. There's a pullback which finds support at the edge of the river. One downward spike. This was a gap down and reversed and started to take off on the 13th. And so this is support at the edge of the river after a successful RLCO. That's pattern 3 in the RLCO framework. We would have not been surprised if right after this first move it had hesitated here at the Bollinger Band mean. If it had and then resumed the move up, we would have bought the continuation, and that's pattern 2. Support at the Bollinger Band mean following a successful RLCO. But that didn't even happen. It blew right through that, went all the way to an RLCO on the far side of the river. After pausing momentarily here, we could almost call that pattern 3, support at the far side of the river, and then a continuation into an RLCO far side of the river. It came down, held support at the edge of the river. That's pattern 3 again, support at the far side of the river, and continues up and comes back and tests that all-time high again at 185. That's where it closed on the 18th. Now, on the 19th, what we have is, in retrospect, a rolling over here. In this case, price violates the southern skin of this dragon right here, and you see it didn't do that. The ribbon didn't come through the dragon, only that one spike, and then it was corrected pretty quickly. But now what we have is 4 hours of price on the wrong side of the dragon. This would be a natural place to cash any final positions that had occurred inside this move. Now, a typical type of a trade in this upward move on the 18th looks something like this. This was a ready, fire, aim trade on February 18th, and this is an XIV. And what we have here is an entry. This is actually the second trade of the first trade. We tried this one, and it failed in here. It was a scratch or a minor loss. Sold off, came outside of the river, outside of the floodplain, and then outside of the third Bollinger Band here. This is a gap down opening and then morning hook. This is a Z trade. That's pattern 7 in the RLCO. Price outside the third Bollinger Band. Re-enters the floodplain. We re-enter not later than the edge of the river in the Z trade. And so the entry number 1 is at 32.54 with a 30-cent stop in the usual way below the swing low. We get an RLCO right at the edge of the river. That's pattern 1. We come up and we are finding support at the Bollinger Band mean. That's pattern 3. Pattern 4 finds support at the far side of the river. This right here is actually pattern 5, the sideways quiet channel. So if you didn't buy this one, this is certainly an entry that's possible because we had market was sideways, the Bollinger Bands had pinched, price and both regression lines were in the river, and then a breakout from the river. That's pattern 5, the SQC, sideways quiet channel. This one did not really follow through any further. It started to hesitate where it did the previous day, and so upon price coming back into the river and getting through the dragon, we go ahead and exit. So with the first entry at 32.54 and then 32.94 with 30-cent stops, exiting everything at a scratch on the second position at 32.94. We end up getting 1.3 R, and then this is rolling over. There was nothing much left the rest of the day. It was kind of sideways choppy. Well, that sets up the next day's trade. And so on February 19th, Tuesday, we see the market starting to roll over at the end of that long upward move in the S&P. And so the day starts, in fact, with a little gap down, morning hook. There's that Z trade again, price outside of the third Bollinger Band. We buy upon reentry of the floodplain with a 30-cent stop, 75.73. Now we're in TNA. This is the triple Russell, but it's the same pattern. It's finding support through here, finds support at the Bollinger Band mean, departs the river. We get a second entry here. We're at 76.50 now. That's 2R in hand plus momentum. This is a sideways quiet channel breakout. That's pattern 5. It mucks around, is not able to follow through any further, comes back in. We see the RLCO on the far side of the river starting to occur. This position is getting weak, so we exit at 76.55, netting 2R out of those trades. And then what we have, shifting over to VXX, we have the market going sideways, showing some weakness. And there was one move up in VXX, which was following weakness in the S&P and all the other broad indexes. And so the first move was up, terminated in a regression line crossover outside the river, and then spent from 12:30 to almost 2:30, a couple hours in this sideways quiet channel, which you can see forming. Now, the first thing that it did was first dipped south out of the river, out of the floodplain, and out of the third period 3 Bollinger Band, or the third Bollinger Band, which gives us a Z-trade pattern 7, leaves the floodplain, goes below -3 sigma, and then re-enters the floodplain. You can actually have an entry here. We elected not to take it. The next thing that happens, it comes all the way back to the Bollinger Band mean. And while it's doing that, you get an RLCO outside the river pattern. That's pattern 1. It finds support at the Bollinger Band mean. What we have is a low, then a higher low. That's actually the lazy W, pattern 4 in the RLCO. So we have a lazy W and finding support at the Bollinger Band mean, which is pattern 3 in the pattern 2 in the RLCO. And now we're stalking this thing seriously. We see weaknesses in all the other indexes. We get a sideways quiet channel breakout. We now see the 90 has crossed the Bollinger Band mean too. So this is actually my most favorite pattern, and so I don't mind waiting through this to get this entry. And so we got our first entry at 42.80 with a 30-cent stop, which is below the Bollinger Band mean. Excuse me. Leaves the river, leaves the floodplain. You can see the Bollinger Bands beginning to expand. The ribbon never really looks back. We find in this blue circle, finding support at the far side of the river after a successful RLCO. That's pattern 3. It takes out the previous ribbon swing high. Finds support at the edge of the river and resumes. This is the lazy W, pattern 4. You could also say this is another iteration of pattern 3, which is finding support at the far side of the river. So you have to buy this. Your 2R in hand with momentum anyway, and you've got multiple patterns. The rest of the market's starting to tank. And then going towards the close, this does nothing but take off. So we're into our second position at 43.50 now. 2R in hand, 30-cent initial stop, and that's essentially just riding this dragon or this modified parabolic stop and reverse all the way into the, near the close. And we take the exit at 44.20 with about 10 minutes prior to the close. Don't want to hold this overnight. Get our exit at 44.20 in a relaxed manner. Not a very good fill, but what are you going to do? The exit at 44.20 gives us 7R on this typical move. And this really looks like the first day of the market rolling over. When you dial out now and look at the 2-hour charts, the move, that 7R move in VXX corresponds with this initial failure move in SPY as it's moving from the RLCO outside the river back towards a target at the Bollinger Band mean. That's why we don't want to hold this overnight, because this could just simply be another swing low being put in, and then the lazy W continuation of this move and getting above 185 and going. That's perfectly natural in this position. But on the other hand, after a move like this from 174 to 185, a 50% retracement would not be surprising, coming back to this powerful support level here. So we're going to look to see, is there support at 182? If not, is there support at 179? If not, this could certainly just be another sine wave, and looking to go all the way back to 174. That would be perfectly normal behavior in a bull market. And so what we had here was an opportunity for 7R in the VIX on the quick hit as the first beginnings of volatility start to shake up, and the long move from 174 to 185 gets weak at at a normal, usual resistance level at the previous all-time high. So what we've really done here is we've taken a look now at a market that has been in this grinding bull, had a sharp 5% sell-off, found support at a natural level, rocketed all the way back up to 185, and now today we have this red candle where it tested briefly that 185 and then has sold off now to 182.5. Day one of potential retracement after this 10-day nice move. Would not surprise me tomorrow to see a big red candle like one of these two. Would not surprise me to see it find support where it found support before and then take a second run at 85. This is all perfectly consistent with the yellow zone, where what I'm going to do is look to see the daily move of the market intraday and try to get in tune with that. And then if it breaks above 185, I'm going to be by default long and strong automatically. Otherwise, I'm going to be tactically trading in the yellow zone. And should it go all the way back to 177 and violate, then I'm going to pick up my downward bias, my directional bias at that point. But I'm tactically trading inside this noise range in the manner we just described, with the 3-minute charts in the RLCO and also the 2-hour and 10-day view using the same framework. So this is Ken Long from Tortoise Capital. Keep your risk measured and your powder dry. Hope you enjoyed this case study tonight. Take care.